Look at this photograph. 1923. A German man uses literally billions of marks as wallpaper because it's cheaper than buying actual paper. We're taught this was a unique monster, a historical freak show caused by incompetent leaders and a lost war, a one-time accident. But that is the most dangerous lie in finance. The same exact economic DNA that created that monster is being actively spliced into the American financial system right now. And the $36 trillion debt mirror doesn't lie. Here's the terrifying parallel they never show you side by side. When the Weimar Republic's hyperinflation spiral truly ignited, its debt-to-GDP ratio had just crossed 100%, a staggering unpayable number for its time. Now, circle the current U.S. national debt, $36 trillion. Zoom in on the debt-to-GDP ratio. It's not approaching 100%. It has violently smashed through it, sitting at over 120% and accelerating. The starting line for our story is worse than theirs. This is the identical mathematical trigger, the same fatal patient vitals. But here's the critical, suppressed difference. Weimar had an excuse, a destroyed economy. The United States is doing this to itself during what we retold is a period of historic economic strength. While you were distracted by stock market headlines and employment reports, the foundation of the dollar itself was being mortgaged at a pace that makes 1923 Germany look cautious. This isn't about government numbers on a spreadsheet. This is the direct precursor to the value of every single dollar in your bank account, your next paycheck, and your retirement fund turning to confetti. The media will tell you this time is different. That modern monetary theory is a magic shield, but the physics of debt have not been repealed. I tracked the actual Treasury issuance data, and what I've found isn't just borrowing. It's a logarithmic curve of currency creation that started ticking in 2020 and is now entering its most dangerous phase. We are not talking about a distant academic theory. We are talking about the next 18 to 36 months. And what most people still don't realize is that the first domino, the signal that the Weimar clock has started here, isn't inflation at the grocery store. It is something happening in a forgotten corner of the bond market that I'll show you next. They tell you not to compare. They say, we have the world's reserve currency, it's different this time. It's the ultimate financial mantra. But that mantra is a confidence game. And this chart is the mathematical proof that confidence is now being actively, systemically eroded. Look at this Fred graph. On the left, Weimar Germany's debt to GDP from 1919 to 1923. Watch this line. It's not just high. See its shape? A near vertical climb in its final 2 years. That's the slope of a collapsing currency. Now, look at the United States, 2000 to 2024. Circle the inflection point, 2008. The line tilts up. Now circle the pandemic period, 2020 forward. The line doesn't just tilt, it replicates the Weimar slope. The rate of change is now identical. This is the anomaly they never discuss. It's not the static debt level, it's the derivative, the acceleration. A country can handle high debt if it's stable, but when the trajectory becomes exponential and politically irreversible, you have entered the kill zone. While analysts debate quarterly GDP, I track this slope. And the data shows the US trajectory has converged with the Weimar pre-hyperinflation pathway. The reserve currency shield isn't a law of physics, it's a perception. And this chart is what erodes that perception in the back offices of every major foreign central bank. The coverage gap is deliberate. You'll hear about the debt ceiling drama. You'll see a headline about the $1 trillion deficit. But you're never, ever shown this side-by-side visual comparison with the complete historical playbook. Why? Because the moment you see it, the "it can't happen here" narrative evaporates. The reality is that reserve currency status doesn't prevent the process. It merely allows you to run the experiment longer and on a larger scale, making the ultimate reset more catastrophic. So how does a country actually walk off this cliff? It's not a single event, it's a script. Germany wrote the 5-stage playbook a century ago, and if you understand the stages, you can see exactly where America is in the production right now. Stage 1 is always debt monetization, the central bank directly financing the state. The Fed swore this was a 2008 emergency tool, but I've gone through the Fed's balance sheet footnotes, and what they're doing now is a quieter, more dangerous version of the same thing. Let me show you the evidence that stage 1 is not just active, it's accelerating. This is not a theory, it is a checklist. Weimar Germany didn't collapse in a day. It followed a 5-stage playbook, and each stage has a modern American mirror that is impossible to ignore once you see it. Let me show you the exact matches. Stage 1, the unpayable bill. Weimar had crushing WWI reparations. America has a structural permanent deficit. Pandemic spending was merely the accelerator. Both create a debt mountain that cannot be grown out of. Stage 2, political failure. Weimar was paralyzed by squabbling coalition governments incapable of fiscal reform. Look at Washington now. a perfect partisan gridlock where no one will touch the true drivers of debt, entitlements, and military spending. The political inability to reverse course is identical. Stage 3, the money printer. Faced with deadlock, the Reichsbank began directly monetizing government debt, printing money to buy its own bonds. Sound familiar? The Fed swore its multi-trillion-dollar balance sheet expansions were temporary. But look at the footnotes of its monthly reports. The monetization never truly stopped. It just changed form. This is the fatal crossover. Stage 4, the smart money flees. As Germans lost faith, they dumped paper marks for Sachwerte. Real things. Land, art, commodities. Now watch the American parallel. The rise of Bitcoin as digital gold, the explosion in luxury goods, collectibles, and real asset speculation. It's the same instinctive flight from currency. Economist Ludwig von Mises witnessed it and warned, there is no means of avoiding the final collapse of a boom brought about by credit expansion. The alternative is only whether the crisis should come sooner as the result of a voluntary abandonment of further credit expansion, or later as a final and total catastrophe of the currency system involved. They are choosing later. The initial dismissal is also copied perfectly. Weimar officials and experts blamed speculators and foreigners. Today, they blame corporate greed and supply chains. Never the source, the money itself. Which brings us to stage 5, loss of control. When confidence finally breaks, it happens in weeks. The currency becomes worthless wallpaper. For Weimar, it led to a total societal reset, wiping out the middle class and birthing political extremism. America is currently in late stage 3, entering stage 4. But the bridge to stage 5 is shorter than anyone thinks. The proof is in a specific, terrifying market signal that appeared in Germany in 1922. That same signal flashed here for the first time ever in late 2023. Let me show you the chart. So how does a sophisticated modern economy actually walk into this trap? The bridge from reckless spending to currency collapse has a technical name: fiscal dominance. This is the core mechanism they don't want you to understand. It occurs when government debt becomes so massive and unsustainable that the central bank loses all independence. Its only remaining mission becomes to prevent the government's insolvency by any means necessary. It must keep interest rates artificially low or directly print money to buy the debt, sacrificing the currency's value to keep the state afloat. The central bank becomes a puppet of the treasury. Here's the simple, terrifying analogy. Imagine you're deep in credit card debt. Your solution? You take a cash advance from a second card to pay the first bill. But this second card is owned by your family, and they have a magic printer in the basement that can create new credit limits. There is no discipline, no limit. You will keep spending, and they will keep printing credit until the money they re-lending you is literally worth less than the paper it S printed on. That is fiscal dominance. The family is the Federal Reserve. The magic printer is the digital dollar. Now watch the amplification channel that is accelerating this, the US Treasury market. For decades, foreign nations like China and Japan were the primary buyers of our debt, funding our deficits. But look at the data. Their purchases have peaked and are now in structural decline. They are quietly reducing exposure, so who buys the trillions in new bonds the Treasury must issue every year? Zoom in on the chart. The percentage of US debt being purchased by the Federal Reserve itself is on a relentless upward climb. They are becoming the permanent, desperate buyer of last resort. This is the monetization playbook. Live in real time. This isn't conspiracy, it's in the cold language of official warnings. Former Fed President Thomas Honig has stated bluntly that we are very close to fiscal dominance. The Bank for International Settlements, the central bank for central banks, has issued multiple reports warning that advanced economies are entering a debt trap, where monetary policy is hostage to fiscal policy. They see the slope. This creates a feedback loop of doom. As the Fed is forced to buy more debt, it inflates the money supply, debasing the dollar. A weaker dollar makes our debt less attractive to the remaining foreign buyers, so they buy even less, forcing the Fed to buy even more. The loop closes. The escape velocity required to break this cycle, massive tax hikes, brutal spending cuts, is now politically impossible. That is the definition of being trapped in the Weimar sequence. And the first place this trap springs shut isn't in Washington, it's in your local grocery store and gas station, through a specific price shock mechanism that always appears next. I'll show you the data that proves it's already here. This is where the Weimar chart stops being history and becomes your bank statement. Fiscal dominance isn't an abstract theory, it is a wealth transfer engine, and it operates on a time sequence that is already in motion. You must understand the layers, because your place in the sequence determines your financial future. Level 1. The 30-day burn. This is the daily erosion you're already feeling, but blaming on the wrong causes. Your cash loses purchasing power faster than any savings account interest can replace. Your carefully planned budget for groceries and gas becomes a monthly guessing game. The price jumps aren't random, they are the direct signal of currency devaluation. This is the wheelbarrow phase, but instead of wheelbarrows, it's the digital number in your checking account quietly buying less every single week. Level 2, the one-year financial system shock. This is where safe money is incinerated. As the market realizes the Fed is trapped, long-term bonds, the bedrock of pension funds, and conservative retirement portfolios get destroyed by volatile rising yields. So-called risk-free assets become anchors of loss. Simultaneously, mortgage rates spike and swing wildly, not based on economics, but on treasury market panic. This locks an entire generation out of housing, turning a basic life goal into a speculative nightmare. Your 401k's stable bond fund is the front line. Level 3, the 5-year societal fracture. Here, the social contract tears. Pension promises, even if paid in full, are broken in real terms. Their buying power hollowed out. Social security payments fail to keep pace with true inflation, pushing retired seniors into poverty. The political response is not unity, but blame and extremism. You see deep social instability as the population fractures between those who understand the game and those being destroyed by it. This is the stage Weimar entered just before the final descent. Level 4, the 10-plus year Great Reset and wealth transfer. This is the terminal outcome. A historic forced transfer of wealth is completed. Those who shifted early into hard assets, productive farmland, energy infrastructure, shares of companies with pricing power, and yes, gold, see their wealth surge in nominal terms and preserve it in real terms. Those reliant on cash, fixed pensions, or government transfers are functionally impoverished. The middle class, built on savings and stable salaries, is hollowed out. A new aristocracy of asset holders emerges from the monetary ashes. Don't trust the official inflation numbers. Here's your assignment. Go to the Bureau of Labor Statistics inflation calculator right now. Plug in $100 from 2020, see what it's worth today. Now, look back at the Weimar slope from our earlier chart. Imagine that value curve not rising steadily but going vertical. That is the personal consequence of the path we are on. But this is not a forecast of doom. It is a map. And a map shows not only the danger, but the escape routes. The people who survived Weimar's collapse weren't luckier. They understood the sequence and moved before the crowd. This separates the prepared from the paralyzed. In the next section, I'll show you the exact 3-tiered asset framework that historical precedent and current data point to for protection and for opportunity. Because in a system designed to transfer wealth, your goal is to be on the receiving end of that transfer. Let's be brutally clear on timing. This is not a maybe one-day problem. This is a when problem on an accelerating clock. You can measure the compression in real time. Watch the speed of each debt ceiling crisis. They were once a distant political debate. Now, they are a perpetual, nail-biting ritual resolved by last-minute suspensions, with the time between genuine cliffs shrinking from years to months. The system is gasping for air faster and faster. The immediate catalysts are already on the calendar. Mark the next hard debt ceiling deadline. It will likely hit in early 2025, but the political paralysis begins this year. More critically, watch the next major Treasury auction cycle. I track the bid-to-cover ratios. Any significant failure of demand, where the Fed is forced to step in as the primary buyer, will be the canary in the coal mine, a public admission of fiscal dominance. That could happen within the next 12 months. Now, monitor these 2 specific threshold points. First, when the U.S. government's annual net interest payments exceed the entire defense budget. We are hurtling toward that line. Second, and more dangerous, when a major foreign holder, watch Japan or Saudi Arabia, formally announces a permanent strategy to diversify reserves away from the U.S. dollar. That is the geopolitical equivalent of a sell signal that cannot be taken back. Experts hedge. They say, no one knows the time frame. That's technically true, but history gives us the boundaries. Weimar's hyperinflationary collapse took roughly 3 years from ignition to ashes. But the warning signs, the fiscal dominance, the political failure were visible for 5 years before the true panic. We are in that visible warning period right now. The clock started ticking not in 2020, but arguably in 2008. The slope of our debt chart says we are now in the final act of the prelude. This creates your critical, non-negotiable window. The window is now, not for panic, but for deliberate, calm preparation. Once stage 4, the mainstream flight from currency, truly begins, it will be too late. Assets will be unreachable, capital controls will be debated, and the transfer of wealth will happen in a chaotic, violent rush. You will not be able to move calmly, you will be part of the stampede. We are in the final moments of the quiet before the storm. The data shows the sequence is locked in. The only remaining variable is your position when the next phase begins. This separates those who watch history from those who are crushed by it. In the final section, I'll show you the precise framework, not just what to own, but when and how to position, based on the exact stage of the collapse playbook we are in. The time for theory is over. History doesn't just show the collapse, it shows the survivors. And the survivors in Weimar didn't hoard paper marks. They owned what the printing press couldn't touch. This isn't about doom, it's about positioning within the inevitable wealth transfer. Your goal is not just to protect, but to place yourself on the receiving end of that transfer. Here is the three-tiered framework, based on the exact stage of the playbook we've identified. Category 1, the protection core. This is your financial lifeboat. It's not for speculation, it's for sovereignty. Hard currency, dollars, Bitcoin. This is the direct escape from a single nation's monetary policy. Bitcoin represents a scarce, verifiable asset outside the direct control of any central bank's balance sheet. It's not about daily price, it's about holding an option against systemic debasement. Think of it as digital Sachwerte. Productive real assets. This is ownership of the real economy, farmland that produces food, shares in critical infrastructure, energy grids, pipelines, data centers, through select ETFs. These are assets that produce essential goods and services, and their revenue can reprice with inflation. They are the opposite of a fixed bond. Category 2, the tactical upside. This is for capital you can afford to allocate for growth within the trend. Commodity producers own the companies that pull real things from the ground. Energy producers and mining stocks, their key advantage. Their product, oil, copper, uranium, is priced in dollars, but their operational costs lag. As the dollar weakens, their profit margins explode. They are natural beneficiaries of the very inflation that crushes cash. Non-USD assets. Allocate to high-quality companies listed in currencies from nations with superior fiscal discipline. Look to Switzerland or certain Asian markets. This diversifies your currency risk and taps into capital fleeing the dollar. Category 3, the speculative edge. High risk, high volatility. Gold and silver miners, e.g. GDX, SILJ. These are not for the faint of heart. They offer extreme operational leverage to the price of the underlying metal. A 20% rise in gold can lead to a 50-100% surge in a minor S stock. But the reverse is also brutally true. This is not financial advice. It is a historical study of survival allocations. Your specific situation is unique. The critical rule, never allocate more than 5% of your total capital to Category 3 speculation. The core mission is wealth preservation and measured positioning, not gambling. The goal is to move before the crowd even knows there's a new game being played. The Weimar playbook is written. Our position in it is clear. The final question isn't if the sequence progresses, but when you choose to act on the information. This separates the prepared from the paralyzed. You're watching this, a question is screaming in your mind. If this is so clear, why isn't it on every news channel? Why aren't your financial advisors panicking? The answer is the final critical layer of the playbook, systemic suppression. Here is why the truth is filtered. First, the structural reason. The mainstream financial media is owned by large corporate conglomerates whose primary business isn't truth, it's access and advertising. Their parent companies thrive on cheap debt and a stable, even if slowly inflating system. A true, urgent warning about currency collapse is terrible for business. It would crater the debt markets they depend on. So, the narrative is managed. Debt becomes a political football. Inflation is transitory. The comparison to Weimar is alarmist. The incentives are perfectly aligned to keep you calm and invested in the status quo until it's too late. Second, the psychological firewall. Normalcy bias. Our brains are wired to believe tomorrow will resemble yesterday. The idea that the entire foundation of our financial lives, the dollar itself, could fundamentally change is cognitively rejected. It feels like fringe hysteria. This bias is the system's greatest shield. It makes the majority dismiss the data right up until the moment their savings evaporate. They called Weimar warnings alarmist until they were using marks for kindling. Third, the institutional lock. The Treasury, the Federal Reserve, and Wall Street are in a symbiotic, silent partnership. For the Treasury, the Fed must be the buyer of last resort. For Wall Street, the Fed's liquidity is the market's lifeblood. For the Fed, admitting we are on the path to fiscal dominance would instantly trigger the bond market crisis they are desperately trying to postpone. They are all trapped in the same lie of necessity. Look at the historical precedent. The economist Bresciani Tironi meticulously documented Weimar's collapse as it happened. He was ostracized. Only years later was his book, The Economics of Inflation, recognized as the definitive post-mortem. The early warners are always exiled. But now, look at the social proof breaking through. The explosive rise of hard money podcasts, the relentless adoption of Bitcoin as digital gold, billionaire investors like Ray Dalio writing entire books on the changing world order. The smart money is already moving, quietly, while the public narrative still sleeps. You now have a choice. Follow the comforting narrative or follow the data and the actions of those with the most to protect. You've seen the pattern. The rest is a decision. Let's zoom out. Is this 1923 on repeat? Not exactly. It's 1923 amplified by a global digital system which makes the outcome both less cinematic and potentially more insidious. The core parallel is not the breadlines, it's the dynamic between the Treasury and the central bank. Look at this side-by-side chart. The Reichsbank's balance sheet expansion from 1919-1923 and the Federal Reserve's balance sheet from 2008 to today, both on a log scale. The shapes are not just similar, they are eerily identical in their accelerating exponential climbs after a crisis trigger. The physics of monetization are the same, but three critical differences change the expression of the crisis, not its root cause. Difference one, the dollar's global moats. Weimar had a broken domestic currency. The US dollar is the world's reserve currency and the medium for global trade. This is a massive moat. It allows the US to export its inflation for years, diluting the immediate pain and stretching the timeline. But a moat is not a permanent shield. It's a buffer that is being eroded with every new trillion. Difference two, financial contagion versus control. Weimar's collapse was analog. Today's system is built on digital finance and a multi-quadrillion-dollar derivatives market. This could accelerate a loss of faith at light speed through flash crashes and frozen liquidity. Conversely, it gives authorities unprecedented tools for control. Think central bank digital currencies, CBDCs, that could be used to manage a panic for better or worse. Difference three, the social safety net illusion. Germany had a weak state. The US has vast, entrenched entitlement programs. These act as a political pressure release valve, delaying the social explosion. But this is a double-edged sword. When these programs finally break, when Social Security payments buy a basket of eggs, the resulting political fury will be far greater. Therefore, the primary risk today is not a hyperinflationary explosion in 6 months. It is the slow-motion erosion of trust and living standards. It's a permanent loss of faith in the long-term value of the currency, leading to a grinding decline where you work harder to stand still, where social trust frays, and where political solutions become more extreme. Your job is to monitor the gauges. Watch these three metrics. TIPS, break-evens, the bond market's own forecast of inflation. A sustained break above 3% signals lost confidence. Gold in multiple currencies. If gold is rising not just in dollars, but in euros, yen, and pounds, it's a global vote against all fiat. The DXY dollar index. This is the ultimate red flag. If the DXY is falling while inflation is high, it means the world is losing faith in our moat. The export route for our inflation is closing. The Weimar playbook gives us the sequence. These metrics tell us what page we're on. And the data says we are well into the middle chapters. The final page isn't written yet, but the trajectory of the plot is now unmistakable. So, where does this leave you? You are now in the group that sees the map. Most people are still just staring at the road right in front of their tires, watching for potholes, completely unaware the bridge is out 10 miles ahead. Seeing the map changes your entire journey. Now, let's turn awareness into action together. Here is your 4-step protocol. Do this in the next 30 minutes. Step 1. The 30-second verification. Open the Fred Economic Data website on your phone or computer right now. In the search bar, type this code, GFDEGDQ100DAS. This is the official US debt-to-GDP ratio. Hit enter. Look at the chart from the year 2000 to today. See that line? That's the mirror. That is the undeniable mathematical slope. You have now seen the primary source data with your own eyes. Step 2. The sharing strategy. Share this video or this analysis with a simple title. The 100-year-old economic playbook we re-following again. You are not spreading fear. You are sharing a historical pattern. This separates the prepared from the paralyzed in your own network. Step 3. The community question. This is critical. Comment below and answer this. Based on the 5-stage Weimar playbook, which stage do you believe America is in right now? Stage 3, monetization, or Stage 4, flight from currency? Debate it below. This is where we separate theory from collective insight. Your perspective is part of the puzzle. Step 4, the serialization hook. Subscribe and hit notification bell. Next week, I am breaking down the one asset class that historically preserved wealth in every single hyperinflation of the 20th century, from Germany to Zimbabwe to Venezuela. And I can tell you right now, it's probably not what you think. It's deeper than gold, more foundational than Bitcoin. The data is shocking. History doesn't repeat, but it rhymes. And right now, the rhythm of the US debt spiral is starting to sound a lot like a very old, very dangerous German poem. You have the map. The next move is yours.